Hello YouTube. We got a lot to cover today, so let's get right into it. Why am I sitting on mostly cash? Well, it's because we are going into a deflation period. We are entering the end of our cycle, and you'll hear a lot of people talking about all the things that are happening. The stimulus is supposed to cause inflation, and what the Fed's doing is supposed to cause inflation. And eventually, yes, they are creating money, but it is more complicated than that. Anytime you question, is something going to be inflationary, you should question first, well, really? How? How is it supposed to be spent? Where is that money being created going? Does it create a self-feeding mechanism? So we're going to talk about why I'm mostly cash, what holdings I am still massively into, and why I'm holding those. And yeah. So first off, let's talk about how money is created. Pretty simple. When debt is created in any form, money is created, but the interest is not created. So anytime debt is created, and when is money destroyed? It's destroyed when you pay off said debt. So money is created when debt is created. Like if you go get a credit card, $2,000, that's $2,000 created. You don't pay off the credit card, you go 30% interest. That 30% interest was never created in the first place. So it is actually by nature deflationary to create, say, unsustainable, frivolous credit card debt, because you will just then go buy something that doesn't necessarily improve your life condition. It won't necessarily improve your ability to take on more debt in the future. So you will then be deleting money out of existence every time you pay off your debt, as well as that 30% of interest. You will delete money from existence because someone else will not be able to pay off their debt. And money also gets deleted when people go into bankruptcy because they're no longer in debt. So let's talk about the current everything the Fed and the government is trying to do to create inflation and to bail us out of this dilemma we find ourselves in, and why it is actually deflationary. Let's first talk about the stimulus bill. Now, there's been talk amongst the Republicans, the Democrats. Trump is trying to push the stimulus bill up to bigger amounts, and the Republicans are trying to get smaller amounts pushed through. And Nancy Pelosi doesn't want to negotiate because that could be seen as weakness. Anything that gives Trump a victory. There's three basic outcomes here. I do think stimulus is coming eventually, but will it happen before the election? Probably not. There are signs of that. There is a caucus involved in that. They are working on a compromise. You've probably heard a lot of news about that. Maybe in a week. It's possible. Next week you might have stimulus. That would be awesome. I would love that. I'm getting unemployment right now. So that's possible. The problem is that would make Pelosi look weak and it would make Trump look stronger. And that happening just before the election, it's not that tactical. So I don't believe that's going to be happening. But we will see. Either way, though, let's look at the stimulus things that they have proposed and they have done in the past. Now, for instance, the Paycheck Protection Program. Now, in order for these, what a lot of these companies are doing that are getting the paycheck protection is, say, a friend of mine, he works at a restaurant, and their catering manager had before all this pandemic, had lots and lots of business. And he was being paid salary. And when the Paycheck Protection Program came in, they used that to continue to pay his salary. And now he's doing other things at the restaurant. But mainly he's just working less and still getting a salary, just sort of spinning the wheels. They have adapted in other ways. They've done some menu changes to make their takeout more appealing. They've started doing self-delivery at the restaurant. This is all great. And that would be inflationary, those things. But the spinning of the wheels of the catering manager, him just still getting his salary, but yet not necessarily contributing greatly to the company, that is actually deflationary. That is using the creation of debt, which will have interest and will cause money to be deleted either when it is paid off and when the interest is paid. So that will be deflationary unless it can support more debt. And the problem is that if he's just spinning his wheels, that doesn't create the sustainable more debt creation to go into the future. Similarly, all these other companies that have seen decreases in revenue, decreases in customer sales, they all are keeping their employees on the payroll using this paycheck protection program to not fire their employees. And if they are able to find something useful for these two employees to do, then it can be inflationary because it can support creation of more debt in the future. Problem is that a lot of these companies, like when you see 30% business revenue decline, you should lay off employees. Or you should find something useful for them to do, usually a combination of the two. You can't immediately find something for them to do that is just as productive as before. So a minor layoff coupled with a redirection change of the company, pivot, as many call it, this can actually work. But the problem is that you cannot just have all your employees doing this right off the bat. You're going to need to repivot the entire company. And if you just simply try to keep everyone employed, that is going to be deflationary because they're not going to be productive to the amount of money you're handing them. Now, it's going to be fine for the company because you're going to get debt forgiveness and all these things. But as general deflation on the entire market, absolutely. You also have the things the Fed is doing. For instance, when they are buying all these corporate bonds or they're buying all these debts off of all these different companies, that infuses cash into those people that own the debt in the first place. But that doesn't necessarily mean that they will create more debt. It means they're in a better position to create debt because their balance sheet is better. They were able to offload bad assets and take on cash, creating a good balance sheet. But this does not necessarily mean that they will be taking on exponential debt in the future. Currently, a lot of people are in debt payoff mode, and they are holding up more cash for the future. Very little people are looking to, I have all this debt from last year, let me go into even more debt this year. Very few people are trying to do that, especially rich corporations. They are in a debt payoff mode. So when one of these people get a whole slew of cash, they may use that cash to buy assets, but they are not going to use it to then go into more debt. Not at this unsecured time. When there is confidence in the market, that is the only time when debt expansion can happen. Even if these people's books do improve, they will use that cash to buy assets. And then after that, it would be great if they used those assets to leverage into more debt and then to expand. And I think that will happen, but not until we start to see confidence in the overall outlook of the future, which is not presently there. We are seeing that this is a multi-year drag, going to take at least till 2023 or something. We'll see when the expansion comes. But these actions are not immediately inflationary. You have to look at where the money is spent, and if it does not create a self-feeding mechanism, like every time like let's just take a restaurant for example. If that restaurant just is trying to survive and it's paying their employees, keeping them all on the payroll, but it doesn't really expand or do anything to adapt to the scenario, then all that debt created to survive will drag the company down. On the other hand, if they are to use that debt to keep their employees employed, and then while they're employed, they do productive activities like they reorganize the takeout menu, or they do deliveries themselves to save on the margin from Uber Eats, or they start doing a new advertising campaign that works better in the new environment than their current advertising. They switch their advertising campaign strategies. And if they do all these things, then you can create a self-feeding mechanism where the creation of debt feeds productive activity to then allow someone to create more debt, to feed productive activity to allow someone to create more debt, and you continually feed that cycle. And that can create an expansionary money system environment, which is what we need to get out of this. But the problem is if you spend that money not effectively, if you spend it in a way that does not cause the self-feeding mechanism, then you will actually be deflationary. No matter how much money you can create $100 trillion, and that would still be deflationary if it was not spent in a productive way. Everyone would think it was inflationary right off the bat. It might cause inflation for a week or something, but then the literal physics of that much money unproductively spent and needing to be paid off, because every bit of money creation is debt, so it all needs to be paid off. And if it's not productively spent, the payoff of that is going to drag more than it lifts. Therefore, it doesn't matter how much money is created, it only matters where that created money is going. So anytime you hear about something and you think it's going to be inflationary, everyone on the news talks about it being inflationary, just know that it could potentially someday be inflationary if the debt is spent in a productive way that allows for the creation of more debt and more debt and more debt, which will not be happening until the banks start lending more. Banks are tightening and will be tightening into the future. So when we start seeing the confidence in the banks to allow for more lending to feed that self-reinforcing mechanism, that's when we will start seeing progress on this. So, what does this mean? It means, well, a couple things, but one is that this stock evaluation is outrageously high. Now, if we had a shit ton of inflation, then you could say that this would correct itself. Then the PE ratios would not be so extreme. It's not showing PE ratio on this because there's some companies that don't have a confusing PE ratio at the moment. But you can look like the company like this, Apple, is at a 32, which is not nearly as high as so many others, like, let's say, Amazon, for example, is just ridiculous PE ratio. Now, inflation could take care of this. It could simply just make this number much better if inflation were to come up. But the problem is that inflation is going to, like we talked about, take years. And first off, all the actions that the Fed is doing right now and all the actions the government is doing with stimulus, those are actually deflationary. Take, for instance, the unemployment. I am receiving unemployment right now. I have not been employed for a long period of time since this all began. So that money is being created and given to me. And if I create enough YouTube videos, sure, that can be inflationary. But let's be perfectly honest, I've been sitting on my ass most of this time. I've done a lot of hiking, which has felt great. But I haven't gotten another job. This YouTube channel is not successful yet. So at the end of all this time, all this money is going to be created on my behalf. Someone's going to have to pay that debt. Hopefully not me. Government, so indirectly me. Anyways, but the paying off of that unproductive spending is going to be deflationary rather than inflationary. So, how should we be prepared for this? Well, you need to be prepared for a crash. You need to be prepared. This is not an investment advice. I am not a financial advisor. This is just what I think I'm going to do, and I'm going to describe as best as I can the reasons why I'm doing it. But you should not consider me a financial expert, because I'm not. And I'm not giving you advice for your own portfolio. You should do your own research and consult your own financial advisors. But I digress. So, some of the more things we need to talk about. Few notes on the state of the economy. For instance, the employment rate. Everyone's touting that it is going down. You're seeing such great numbers. They're not anywhere near the recession, except the problem is that I'm still on those statistics. I haven't been to work since sometime in February. But I'm still counted as employed. So these numbers are all screwed. And in many cases, they are worse than the recession times. So you have to wonder what kind of state the economy is really in. We all know it's not truly as good as the stock market seems to think it is. I mean, we're already breaching new all-time highs, as if this never happened. And then, this is just the panic in the market. But we all know that real things took place then. Real people got laid off. Real people are currently only paying their rent and buying their goodies, and in many cases paying off their debt because of the government money. But that's creating a behavioral pattern as well that is deflationary. Everyone is a little scared. They don't know when the government money is going to run out. There are still problems with when is the stimulus going to happen before the election or not at all. Everyone's still concerned. They're just not feeling empowered. I know this myself. I am keeping massive amounts of savings for two reasons. One is to invest in the dropping of the market. As you can see, most of my holdings are in cash right now, and that's just what I have ready to invest. But I'm also saving a lot, and I'm paying down debt. And a lot of people are doing this because they don't know where their income is going to be coming from in the future, even if they are currently flush with money, and many people are. I was getting $1,000 a week from unemployment, which is just ridiculous. That's why I didn't go get a job. It's freaking ridiculous. I've made that much money before, but consistently that much money? Oh, never. That has never happened consistently for more than a week or two at a time. So the chance to make that consistently for months on end, not even have to do anything at all, go hiking all the time, that has been great. So of course I'm not going to go out and do something productive. So the state of the economy is non-productive. That's the main point I want you to take from this, is that there is a lot of money creation going on, but is very non-productive. Therefore it is deflationary rather than inflationary. So we will see deflation first, then we will see inflation. Another few things like about the stimulus bill, for example. A lot of people are holding firm. Nancy Pelosi doesn't want to be here a week and negotiate. She doesn't want to give Trump a victory to stand on right before the election. I don't think it will happen before the election. If it does happen, though, we will need to see some pain first. For example, the stock market has rebounded. That is the biggest thing. We saw a stimulus package go when the stock market was cratering to the floor. Ever since, because the rich were in trouble. Now the rich are not in trouble. So we're not going to see any stimulus. When the rich are scared, then we will see some stimulus. But it doesn't really matter if the average Joe, you and I, are scared, because we don't run the country anyways. It's the rich that runs the country, and so we will see help when they start to get scared, which is when the market goes down again. As well as there's a lot of tenants, oh, this is big. So tenants this second week of September, has never been so high as now for the tenants that are not paying their rent. Even during the worst part, if you want to say that this was the worst part, apparently not for tenants. Tenants were still pretty flush with money from the jobs that they either had just recently lost or hadn't lost yet. And in here, they still got unemployment money. But now, later on, everything's starting to come into question. That unemployment money is running out. I myself was getting $1,000 a week. Now I'm just getting my $400. And in theory, that's supposed to be more than that because the thing that Trump did with the executive order, another $300. But I haven't gotten that money yet. It's all just pending till who knows when. So someone in a more difficult financial position than I am, or if I just spent that $1,000 as if it was always going to be there, and if I continue to spend like that, then I would be one of those people too that would be unable to pay my rent right now. And that is why the numbers are getting worse and worse, because it's no longer $1,000 a week. There's no longer that $600 extra. It's all in question about whether or not there will be an extra. And even though Trump did do his executive order, many of those people, like me, have not seen a penny of that money. So we're still surviving off of a percentage of our employment money. For myself, that's $400 a week. It's whatever the standard unemployment benefit is in your state. For me, it's very, very high because I live in Washington State. Most people, it's not that high for, even if they got paid more than I did. Washington State just pays more than most. So a lot of people cannot survive without that extra kick, and they're not trying to find new jobs because there's this whole idea that somehow the economy is going to come back, or these benefits will eventually, there's just some time in the future that they're going to go job searching, including me. I don't want a job search right now. I'm getting paid too well. Even though I'm only getting that $400 a week, in theory, I'm getting $700 a week because there's that extra $300 thanks to the executive order. So as long as that comes through, I'm making $700 a week, which I could maybe make more than that in the market, but it would be tricky and hard. That would have to be a good full-time job, versus not working at all and still getting all the money. So I'm not working. I'm going on hikes. Except there's been these fires recently, so I haven't hiked. Fires really suck. Anyways, so I do not think we will see another stimulus bill until we start seeing some more pain, until we start seeing either some of the renters, if we start seeing evictions, that will start seeing some major pain. That's what we're ultimately going to need before we get another stimulus, before this market crashes a little bit. It's heartless to say it, but we're not going to get any help until some people are homeless, until those numbers go up. They are already going up, but most of those people are poor and are being ignored, as the poor often are. Once middle-class average people who are managers in respectable companies, or at least they were before, once they start becoming homeless, that's when people will start to notice the pain, when, respectable people start dying off. No one really pays attention to when the poor dies, unfortunately. We really need to get better at that, though. Now, if none of these compromises happening, will Trump simply act on his own like he did with the executive order with unemployment? And he might try to do something like that. The biggest problem with that is that before he took FEMA money to do that, he borrowed money from the FEMA and to pay off, borrowing from Peter to pay off Paul. So the problem is that money has run out, or it's very near running out. And we just had all these fires. A lot of them, FEMA is supposed to be for disasters. The coronavirus is a disaster. There's just a lot of places that money is supposed to go. Everyone is trying to get their hands on that money, and if you try, and it already could only support, what was it, 15 weeks or something like that? I don't know what the numbers were, but the point is that it could only support a limited number of weeks. That was before the fires in California, Oregon, and Washington, and the emergency funding being sent there. And there's emergency funding for coronavirus, and there was the tropical storms and hurricanes. So everyone's reaching for these dollars. It's like musical chairs. Everyone wants this FEMA money. So if he tries to fix everything with executive orders, there's just not enough money. There's just not enough money. More needs to be appropriated, and appropriations is handled by Congress. Trump cannot appropriate any more money. He can stretch his power as much as he wants to move money around, and he's done that. And I definitely presume that he will in the future stretch his power to lengths that no one has seen before in the past. It will be all over the news, absolutely. But at the end of the day, he can't appropriate new money, and that means everything he does is very, very limited, and ultimately only creates more pressure. No one's talking about the FEMA money being ran out, but it is already ran out. He dedicated it all to spending for unemployment. California and Oregon are drawing on that for the fires. The money's already spent. It's just not on the news yet. Soon that will be all over the news that the FEMA money is out. And that's when we'll start to see some more pain, is when everyone realizes that their extra $300 a week that they just see online, that, oh yeah, it's pending and I just need to survive a little longer. That's exactly what I'm doing. I just need to survive a little longer and I'll get that extra $300 a week. Well, when they realize that FEMA money has ran out and you're only going to get this many payments and that's going to be it, that's going to be a rude awakening for a lot of people, including me. It's not going to be fun. I don't know how many payments it's going to last for. So in the light of all these things, when are we actually going to start seeing massive deflation and massive inflation? How are those cycles going to take place? Well, I don't know. I have no idea. And you really shouldn't trust people who are giving out specific predictions anyways. And I'm not a financial advisor, but where I'm feeling, and for my own sake, I do believe that we had a low and a low and a low. Each one of these were a lower low with higher highs. So we will be retesting and see a lower low. If it went down now, that would seem a little soon, considering how many months you just see from this one to this one, how many months you see from this one to this one. It could be nowish, but I'm thinking it's a little bit more over here. We will see. These things take time; they take months. But the important thing to be realizing is that there is a lot of money being created right now, but all of it is deflationary. There is no inflationary money being created right now, and the Fed themselves have projected all the way out to the year 2023 that's when they expect to see inflation. An important thing to realize then is that I do believe we do want to be fully invested before that time happens. They have already said that they want to let it rise above the target 2% for a prolonged period of time to do that averaging out. The problem is that once inflation really gets going, especially when it's fed by the Fed, and you can see this in all sorts of countries all over the world that have had inflation problems, is that a lot of times they will have trouble getting inflation going for a prolonged period of time, and it could be really bad, but eventually I think it will get out of hand. And especially since they've actually planned just to let it run. They want to let it run above their targets, 3, 4, whatever percent, and then let's pretend it actually got up to like 7%. They would still at first not change a thing. They would think that is great because they're looking for an overall average over years of 2%. So if it reached 7% for a short period of time, they wouldn't do anything. They wouldn't be scared. They would just let that happen. The problem is that that could feed into itself and continue on forward out of control. So there is a possibility of runaway inflation eventually, but it will come after we are done with all the deflation. We have to reach a bottom and a new expansion of debt. That will be years in the future. So we will talk about that more as it comes up. In the meantime, you should be preparing yourself for value companies is where I'm sitting. I like Boeing. They are a duopoly. They are going to survive regardless of how much money they are currently losing. Their 747 problems, it is a mess, absolutely. That's why the stock was so low in the first place. You saw it just got shaved. Actually, when the Boeing 747 problems started happening, it didn't even affect the stock at all. But with the double whammy and coronavirus and everything, finally it took it down a notch, and still actually only to some previous numbers. It's still actually not even as low as I would like it. But on a 30-year trend basis, the airline business, I believe, will do just fine. Which is why I am in other companies like Alaska, and Spirit is related to Boeing. Most of their revenue comes from them, so just consider that more Boeing. But after, say, 9/11, there were substantial losses in airfare globally, but that all came back. And really, if you look on a 30-year spectrum at averages, it was barely a blip. So airlining worldwide expands every year, with exceptions, absolutely, like 9/11, absolutely. It dipped way down, really messed up the average for a blip of time. Not something you should really concern yourself about if you're a long-term investor. So that's where you want to be. You want to be with companies that you're comfortable with, that if their value goes down, which they might, that you would see that as a buying opportunity. If you were looking at any of your companies, and I did this earlier today. This is a much shorter list than the companies were. I sold out earlier. If we look at my activities, you see I sold out of all sorts of things, and many of these I had already sold out the majority of. I even lowered my exposure on Boeing. It is my largest holding, and I do want to stay in there, but I don't want to be that exposed at the moment. I'd rather be in cash. So I left $2,000 in there, $2,500, but I took out 1,000 just so I'm not more exposed to it. Some of my best winnings, like Tupperware. If you see Tub, oh my gosh, that was a good buy. So, oh, wrong letter. Tub. Okay, so I actually got it right. No, that's when I sold it. So I got it somewhere in here near bottom. I don't exactly remember where, but it was very much near the bottom. Averaged in around 250, let's say. That's probably actually more than I paid for it. But point is, though, is if you look at just pre-corona times, here's the corona drop, and it has gone way above as if the coronavirus just never happened, which is just ridiculous. And this, as this could in theory keep going up, sure, because you have recent level not too long ago of all the way up here. But you're also holding a lot of risk that it could go down back to these levels, especially in another retesting of those lows. If we retest the lows, then that's going to be coming back down, I believe. A lot of companies will be coming back down when we retest those lows. Once everyone realizes they can't just keep piling into Apple and Tesla forever. If you own any Apple or Tesla anymore, I mean, I get it. I bought into the hype too. I bought some Tesla and some Apple right before the split happened, but you should be out of that by now. At least I am. That's my opinion. Technically not investment advice because people can get in trouble for saying that. That's just what I did. I definitely got out of all my Tesla and Apple. So you see how I have structured basically my portfolio. What I've left in there are things that have already lost a lot of their value recently, so that it would be tricky for them to go down any further. Actually, silver though, that's a fluke. Well, not a fluke. I just am never willing to sell at all of my silver. I did sell about 1,200 of it. I had about 1,200 more dollars. I also have 100 ounces on silver bullion that I never plan to sell. So I absolutely love silver no matter what price it's at. I will never sell all of it, but I did sell a good chunk of it, about 1,200 of it, just because, well, as you can see, it has been spiking ridiculously, as silver and as many things do. If we look at the 5-year chart, it's just ridiculous against all all-time highs. This is just ballistic and insane. And if you look back to February, it did take a dive just like everything else did. Everything took a dive back in February. It doesn't matter what it was. Hell, even Apple took a dive back then. So I may be holding on to some risk there. But it's one of the few things that has true value, so I'm not selling out of all of it. I am looking for things that did not fully recover, but have otherwise good outlooks for the future. Basically, if you look at a company like Apple, for example, the problem with, say, Apple is that they are way above what they were in prior to the crash, prior to all this coronavirus crap. So if you were just thinking, just in a basic standpoint, are they in a better position or in a worse position than they were before coronavirus? And well, that might be the wrong way to put it. Positionally, they might even be in a better position, but all their consumers are kind of screwed. Their consumers have lost their jobs. Their consumers are sucking off the titty of the government. Their consumers are getting a whole bunch of stimulus money that is all deflationary in nature, like we talked about. It's not being productively spent. Therefore, it will just cause deflation. So has their condition really improved on the broader state of the economy since this crash? And the answer is no. So all this recovery represents risk. It's risk that it could fall back down. Whereas a company like Boeing, for example, at least my thinking, is that there is some intrinsic true value to Boeing somewhere down there. I'm not sure what value it's at. It might be really low. It might be pretty low. But there is an intrinsic value to it, mainly based on the fact that it's a duopoly and that even for Social Security reasons, it won't be allowed to fail. We won't concede the business of building airplanes to Airbus and to China. That would greatly ruin our strategic position. So the powers that be won't let that happen. We need to dominate that industry, or at least have a foot in that industry. Boeing will absolutely be bailed out. That is my opinion, not official investment advice, but definitely my opinion that Boeing has an intrinsic value due to its position in the market as a duopoly and its necessity for national security. Lots of military contractors will be in a similar position. Not all of them, though, because a lot of them can be replaced by simply a different military contractor. So you'd have to look more carefully at that, and that's why I do think Boeing is in a unique position, because no one else produces planes. You literally have Airbus, China, and Boeing, and that's it. Which is, it's a tiny marketplace for those that actually have the ability to produce planes. If anyone else wanted to produce planes, it's not like they don't have the eventual technical experience to do so. Sure, they could hire the people, build the warehouses. That's the other thing. The biggest building in the world, well, more recently it's the Gigafactory that Tesla built. But before that, it was the Boeing building in Everett, not that far from where I live, where I grew up most of my life. And when Boeing has layoffs, this entire area is in an economic free fall. But that's another story. But point is that it's already offloaded a lot of its risk. Other companies, Invesco has offloaded all this risk. They were carrying all this risk. If you bought into here, that kind of sucked. I did buy some into there, because if you look at the 5-year chart, that is low. So I did own some in here. I think that's my Robinhood. You look at total return. Oh, ouch. Oh yeah. That sucked. That sucked. But my M1 Finance, I was able to buy mostly into this bottom section in various different price points. And that's going to have a bottom to it. Where exactly that bottom is, I don't know, but you're not holding on to the risk of it going from 36 to 10. That's massive drop. 10 is a third of the previous, so I don't think it's holding on to that much risk. If you look at, say, long term, Investco, and you look at the max, you'll see that its recession lows back in, say, 2008 or the year 2000, we are at those levels already, and we're not even finished with this pandemic. So we're already seeing good prices. The dividend is actually much more than this, because they cut their dividend, and normally, like, I'd be really annoyed at a company that cut their dividend, but really everyone took coronavirus as an excuse to cut their dividend. So there's a few companies like AT&T that can't cut their dividend because they're famous for being the dividend king, and just like the fact that they haven't cut it in over 30 years, they're kind of locked in a box. Kind of like a lot of politicians get locked in a box, like Nancy Pelosi keeps on saying she's not going to negotiate, which doesn't allow her to negotiate in the future. She's putting herself in a box. A lot of companies like AT&T have been put into this box where they can't lower their dividend. Other companies who have lowered their dividend in the past are able to use the coronavirus as an excuse, and a lot of companies have. On a deeper level, you shouldn't be paying too much attention right now, I believe, to whether or not they cut their dividend. You should be looking at their cash flow, their financials. It's simple. You can just click right here, financials. This is not the view I prefer. I prefer Yahoo or NASDAQ, but you can clearly see that their cash on hand, even during these 2 quarters, and these are the 2 quarters that are really insightful because this was during the collapse, all the coronavirus problems. And one of the things I did was pretty much there was a lot of recovery stocks I had that I bought on the dip during that time. When we saw that it was that negative day in oil. If anyone remembers that, and I heard it on NPR that oil was negative for a day. Well, guess what I bought on that day? Oil. A lot of it. Not directly. I bought every company I could imagine that was in oil. And I made a ton of money because they all went up. Like if you see this number here, that I have all these gains. Yeah, a lot of those were in the past quarter, different times. But I need a 2-quarter button. If I had a 2-quarter button, it would really show it. But I made a ton of money buying oil at the bottom. I also bought travel, like Carnival company. It's doing bad right now. When I checked their financials, just going over to financials, just like anyone can do. Well, apparently it takes more buttons. But the point is that when I checked it, Carnival now, it did not make money through those 2 quarters. So I stripped down when I was selling out. When I did all these sales and the sales before that, you see more sales, 17 sales, 20. Here's pretty much $1,500 worth of sales, $1,600 worth of sales, 500. I guess that balances out to be about $350 in sales. And if you go back further, it's even more sales. I've been selling out of this market. Oh, wow. $4,000 of sales right there. Wow. So, yes. I've been getting out of this market, but I was fully in at the bottom, and that is pretty much my plan going forward. I'm holding down cash, and I'll be looking to buy up some of these value companies in the future, but my main determination for whether or not I'm going to be in a company is that I have this great test comparison. I can look at what they did during the last crash, during the time of the coronavirus, and those companies that have good cash flow during the crisis, those are the companies that I would feel comfortable going into. And if you look at any of the companies I have actually, well, that one's a bad example. There's other reasons why I'm still holding that, and maybe I shouldn't. But that's a story for another time. But the majority of our companies, I am very confident that they have the cash flow to sustain them through even things going back to the way they were or worse. We get a second wave or election. Their positions might be weakened slightly, but their position is not going to be massively effective. I don't know. Let's look at an example. Yeah. All right. So, for example, let's talk about Energy Transfer. As you can see, Energy Transfer, a lot of controversy around it. These are that pipeline everyone doesn't like. Yeah, these guys built it. So, point being is that its stock didn't rebound very much at all. It's still extremely low. Huge dividend. It is in natural gas. Natural gas has been having all sorts of problems right now, but their cash flow has extended throughout this. If you look at their operating income, has it taken a hit since, say, 2019? Yes, it has. It has taken a hit. You should see a drop in the price of the stock, but it has not gone negative. Other companies that I used to be invested in, that I bought on the bottom of the dip, their operating income was negative or down massively or just otherwise having a lot of revenue problems. This company, are they experiencing revenue problems? Absolutely. Everyone experienced revenue problems, but they were able to stay profitable consistently throughout it. And that's the main thing you do want to look for. Are companies going to be affected by this? Yes, absolutely. And you want to stack companies that have cash on hand, that are creating more cash on hand. If that cash on hand did go down, that's of course not as good as if it had gone up, but it's fine. And you should expect that a lot of different companies, their cash on hand is going to go down during this time, because everyone's cash on hand is going to go down. Some companies it's going to go up, but those companies are going to see massive shoots up of the stock price. These other companies that have seen, like say Energy Transfer Partners, their stock price has not recovered. We are still seeing it on a great value. Eventually it will recover as long as they're able to produce positive cash flow in the meantime, which we just checked. Their financials, they did just fine during the worst of the time. So eventually they're going to do just fine and come back. So the more discounted the value is now, the better. And that means that there's a little bit of pain. You have to buy into that fear a little bit. And right now there is a lot of fear around natural gas. A lot of companies are running into a lot of problems. But the industry of natural gas, is natural gas going away? And the answer is absolutely friggin'ly not. Natural gas is going to be a part of our economy for a long period of time. That's not a political statement. It has nothing to do with, is it good for climate change or not, blah, 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 blah. Oh my gosh, do not invest based on your beliefs. Invest based on reality and the way things are. And the way things are and the reality is that natural gas is going to be part of our economy and the world economy for a prolonged period of time. Regardless of who becomes elected and how much of a green agenda we have in the future, it's just a fact of life. It's a massive economic force and it is going to be in our future to begin with. So I did absolutely sell out of some companies. If you look at the activity and the sales, Apache, their natural gas, sold out of them. Their cash on hand is going down. They're losing money. Same with Crestwood, I went out of that. Fun is in their entertainment business. I got out of that. There's things like HT. I know HT is in here. Oh yeah, hotel hospitality. They are seeing negative cash on hand coming through. Their operating income is doing terrible. But there are other companies in those same exact fields that are doing relatively okay. You know, they may have seen some suffrage to their operating income levels, but they're still doing okay. Like Service Properties Trust, they own a bunch of hotels as well, just like HT. Pretty much the same story there. They just own different hotels that are doing well, that are not doing well, that are doing okay. Their revenues decline, their operating incomes, everything's declined, but they're still producing fresh cash flow, and that fresh cash flow will sustain them just fine throughout this. And in the meantime, they are on sale. If you just look at the charts, could the stock go down? Yeah, it could go down, but down to where? As long as they are still producing fresh cash flow, there is some bottom it has to stop at. If the company goes bankrupt, then I'm wrong, and that would be very bad. But assuming this company is not going to go bankrupt, assuming it continues to produce cash flow like it did the last few quarters, then this is just a drop, and that's just an opportunity to buy on the low. And if the entire market goes down, how much further can this go down? I don't know, but it already went down so much, so maybe it drops back down to, well, see, when it was at 4, it stayed there for like a day. So we're looking at like 550, 6, somewhere in there. Could it retest those? Absolutely. Could it test something like $3? Absolutely. But it's pretty clear that no matter what happens, it's going to find its way back to these levels really easily, and that's just because the company is producing cash. Even at the worst times, it is producing cash. So there has to be a bottom to the stock numbers. And the closer you are to that bottom, the less risk you are holding. So I'm holding on to these companies, but no, I still see risk in the market, so that's why cash is my largest position, almost equal to the stocks I have, and that I have more cash in other places. That this is not all the cash. I have much more cash, and that's where I would greatly suggest the majority be. Not technically investment advice. I am not a financial advisor. This is purely for entertainment purposes only. And hopefully, I hope to have even more cash soon. I have 2 debit spread puts on the market. So it's gone all over the place. As you can see, it was down 13%. Right now, it's up 16%. But what I'm waiting for hasn't happened yet. This was bought, if we just look on this chart, I bought this right around the time that this was peaking, right around there. I wasn't sure how much higher it would be going. We might get a blow off top, or we might go down from here. I don't know, but that's why I planned out my short till June of next year is when I think it's out till. Does it say the expiration date? Yeah, expiration date right there. So hopefully, for my sake, the market crashes before then. That will be bad for a lot of other people, the general economy in general, but you want to position yourself to profit from this. So I have hopefully positioned myself to profit sometime if we just retest those lows. That I do think that for like the full crash, that it might take even longer than this. I would be looking to vacate this position when we retest these lows. If we get another bounce, like this low, that low, and this low, so we get another one around this low, but out here, so it'd be somewhere around here. If that happens again, I believe it is happening again. I bet $2,000 on it happening again. If that happens, then that's when I will be vacating these positions. We'll likely recover a little bit and go down again, and we'll see. I do think the crash will be much further and much later, but I will be entering new short positions before then. We're probably just going to have another test bounce. We'll see. There was a lot of bounces in 2008, so I do expect there to be more bounces, more opportunities to buy some more. Like if oil goes negative again, that will be another great day to buy oil. There were a lot of other commodities that dropped then. Lumber for right now is extremely expensive. I wish I had bought into lumber companies on the drop. Might get another opportunity to do that. We will see. So look at commodities, look at where some real value is. There's definitely some opportunities to come in, but I would be very cautious to turn your cash into investments, because where's the bottom? Like, are you really gonna be so lucky to pick this bottom? No. And when I bought all my stocks that I made a ton of money off of during this time, I did not buy on the lowest of the low. Some I did, because I still had some left, but that's because I didn't try to buy the bottom. I tried to just buy this whole area. I started investing in, I think it was around here when I started going in pretty heavily. And that continued throughout all this, and I kind of stopped after that point and got a little scared. Like when everyone else is getting excited the market's gonna go up forever, you should be getting scared. On the other hand, when everyone is scared down here and there's all this fear and everyone thinks it's gonna go cratering to the bottom, you should be sprinkling your money in. Buy when there's blood in the streets. It's the only way to get rich in this world. That's what you're told by. Oh yeah, it was Baron Rothschild. So he said, buy when there's blood in the streets. And that is so true. Or as other people might have said it, when everyone is fearful, you get greedy. When everyone is greedy, you should be fearful. Same basic idea with the market. You got to be very careful to buy when everyone is scared. But you're not going to be able to pick the bottom. So I would say hold back and try to dollar cost average, but I don't dollar cost average like other people do. I would say college dollar cost averaging is a great long-term strategy to start at. Anyone just starting out, I would suggest you just dollar cost average into whatever you want to get into to familiarize yourself with the idea of investing. But I prefer for myself and for more advanced users a more hybrid approach, which just pretty much is dollar cost average with a tiny bit of your money, but hold most of it on the side, and then dollar cost average a little heavier when you see blood in the streets. So I was dollar cost averaging, I don't know what the money was, but it was probably like $50 a week. But then down here, it was $200 a week, or I don't know what the numbers were. But my point is that I was dollar cost averaging into the market before that, and I just increased. I had cash on the side ready to go in, and I increased that dollar cost average. But you don't want to just throw all in. You will make dumb decisions. Like, for instance, if I threw in $5,000 here, thinking that it's the bottom, then it goes way down to here. And so you just want to pick up good value companies, focus on lowering your risk. Companies like, say, Tesla, for example. I would love to get back into Tesla. I do miss having Tesla shares, but there's a lot of risk, and I don't know where the bottom of Tesla stock is. Now, is its top eventually going to be past what it's currently at? I mean, will it eventually, Tesla, let me just look at these numbers. Do I think it will eventually go even higher than these prices? Absolutely. I do fully believe. I'm extremely bullish on Tesla. I don't really care what the value is, and I will still be bullish on it. But we have to talk about time reference of terms about that bullishness. And in times of risk, like if you just look here, they did suffer from that drop. And where is the bottom on Tesla? The problem is that since Tesla does not produce enough cash flow, since their PE ratio is so ridiculously high, even higher than Amazon, where is the bottom? And anyone could guess at that bottom, but no one would know the bottom because they just don't have the cash flow to buy their stock back to bounce that bottom back up. They are profitable. Absolutely. They're doing great. Love what they're doing. But where is the bottom? I don't know. They do have cash flow. There is a bottom somewhere. They're in a much better position they were in 2008, for example, where there wasn't really for sure being a bottom, and then like everyone was going bankrupt trying to survive. Elon Musk was in debt and almost bankrupt, borrowing money just to pay his mortgage. So 2008 was a tricky time. I don't think it's going to be that tricky for them this time around, but I just don't know where the bottom is. And that's the main problem, is that we are currently at a high, and the bottom is somewhere. I don't know where. But if this price were to drop to, say, 200, for example, I still wouldn't know where the bottom is or how close we are to it. So that's the problem I have with investing with a company like Tesla. I will be looking to get back into Tesla, but it will be when I'm more sure that we are at a bottom. And really, they never really got to that bottom, even during the last little test crash. They didn't go down enough, and that was because they just had this short rise. They had this short rise, which got everyone excited, and then they just had a little dip, which it's a substantial dip. Oh gosh, it's a really substantial dip, 40%. Whew. But that still didn't bring it down to really any. That's still 85. That's still an all-time high. So they still were at an all-time high in respect to all the other previous values before this short sale. By the way, in another future video, we'll talk more about short sales and why this happened. This is because of shorts. People needed to cover their shorts, and so they needed, as the price went up, it first bottomed out here, or here. Here's where it bottomed out. Everyone was shorting the market. Those shorts became wrong. They had to cover their shorts, which means they had to buy stock, which led to it going skyrocketing here. And that led into a frenzy and some other things, and their stock split announcement. There's a lot of things that went on here. But to be important that this is FOMO, this is hype, and will it eventually make up for this value? Absolutely, but that will be sometime in the future. There's a lot of risk in the market right now. Coronavirus, election, this recession we're going to have. I mean, just look at 2008. SPY. So has this happened yet? No, this happened. If you look right here, you have this little dip and then it comes up again, or here you have this little dip and a new high. If you look at these things, if we were to zoom in on these, which I would need to go to a different platform to do, but you can do this in your own time. It's really easy to see that these look more like what we've been going through. In fact, right here, we haven't seen a lower high yet. This would be a lower high, and you see that happened right before the fall. We really have been seeing things like this area. This area looks very much like this area. It's all on a smaller scale, but you can see a low, and a high, and you can see those gaps, and it's all getting shaky. But we haven't seen this yet, and the long time to go back up yet. And you see that pattern here. It takes some time to go down, and you have that long time recovery. We're not in that phase yet. We are still near the top. And so in that level of risk, I would not be holding any companies who I don't know where the bottom's at, where their true intrinsic value is. Anyone that's in question. Amazon, for another example, amazing company. I want to own Amazon, absolutely. Amazon's got a good future. I definitely want to be in Amazon stock, but where are they going to bottom in this recession coming up? I don't know. They don't produce a dividend, so their dividend's not going to catch them. So what's going to stop it from going way down? Eventually it will be stopped because this is a very valuable company. It has a bright future. In particular, the e-commerce is getting boosted even more with this coronavirus thing. All the competition is shutting down. Amazon absolutely has an extremely bright future ahead of it. And will, if you want to go long term, if you want to buy into this, fine. I'm fine with that. It's just, no, I'm not fine with that. Because, you just don't get impatient. If you want into a company like Amazon, I want to be in Amazon. I want to buy them. I'm not going to FOMO into them at the moment, though. You have to look logically when you're going to buy into the stock. And that's why I do like dollar cost averaging with a small amount. If you want to buy into Amazon right now, go ahead. Put small amounts into it, maybe $10 a month or $10 a week. It all depends on how much cash you have in the first place to do this. I would say maybe a small percentage of the amount of investable income you want to do, and a much larger percentage of the investment income that you want to do would be sitting in cash for the future. And then I would say when your investment looks in the red. So at some point in the future, if you see that your investment, you buy $10 of this a month, buy $10 of this a week, whatever you do, and then it plummets down and your investment is down 40%, that's when I would say you should start to increase it to maybe $20 a week or $20 a month or whatever. But you would still want to spread out that buying. You don't know where the bottom is. And just don't throw in all your money when you think it's bottom, because it's not. And I would much rather buy. I did do a lot of my buying. As I mentioned, I bought on that day that the oil was negative. Yes, but I did most of my buying in here, and that's because there was less risk at the time in here. Technically, the bottom of the market was here, and if I could have been magical and predicted that, it would have been awesome to throw in all my money in it all at once. But I would have likely dumped it in around here. That's when I first started dumping in, and I just would have lost that money. So where is that level at? That level is about 270, 240, whatever. And then I might have panicked out. I would have temporarily lost a lot of money before it then came back. There's a lot of risk because it could have gone down and never come back up. Like, this might not have happened. So this is a time you should not be necessarily increasing your buying. Now, when it gets down further enough, this is where I would start to increase my buying. And then as it starts going up again, keep increasing your buy. And then somewhere in here, yes, you got to be getting fearful again and start tapering it off. So we were looking for another pattern like this to come up. It might not peak out again. We might still get a run off top before we retest this, or we're going to retest this and then get a blow off top. We will have to see. But I would say be holding cash and preparing to retest this. And in the long term, we are going to see first deflation until we get a time like we had in 2008 or a time like we had in the year 2000. Once there is enough deflation in the market to achieve a bottom, we will not see an expansion of the economy until there is new debt creation created in a productive manner. So be watching for the stimulus plans, be watching what the Fed is doing. Don't be asking how much money they are creating, be asking where that money is being spent, and will it cause a chain reaction of more debt to be created in the future. And when that happens, that will be, you will start to see this confidence go up, and you will start to see debt expansion, and this will be a great time to buy in. All this time, you don't need to buy the bottom. Don't even try to buy the bottom. Or buying in here. You don't need to buy in here. If you bought in here, all these years were great years to buy. All these years were great years to buy. So I would look to spread out my capital throughout these years of buying. Trying to pick the bottom, you'll just fail to do that, and then it'll go down, and you won't be able to invest properly after that. And the other big problem of that is that I bought a lot of oil companies at the bottom. I probably should not have bought all of them that I did. I didn't yet have a test to know which ones were going to recover nicely. If the entire market didn't recover so ballistically and crazily, then I could have potentially lost money because I bought some companies that aren't doing so good anymore, and I've since divested and gone out of them. So you buying it too early could get you to buy the wrong companies that haven't gone through the stress of the worst of the times yet. So when we're buying in and placing our capital, we want to try to get the most of it in when our confidence is high as well, and that won't be happening until you have this turmoil time. You'll be able to see the quarterly reports. You'll be able to say who is having cash flow continuing during this time and who does not have cash flow during this time. And I would position myself in the companies that had cash flow during this time, which you won't know till after the fact. Then you will be able to look back and see which companies had cash flow positive at the time and make those investments. Another thing is that you don't know anything about investing until you own a position. That is something I learned at the beginning of investing. It is so true. So if you want to learn more about investing, start investing. Not with your money, not with a lot of your money. A tiny bit of your money. Own a position. The longer you own a position for, the longer you will have your mind on it, the longer you will understand it, the more prepared you will be when the crash comes. Don't panic. Don't sell out. Just realize what's coming and position yourself accordingly. And don't let your fears and emotion dictate what you're doing. Be greedy when the market is fearful. Be fearful when the market is greedy, and you should do fine. But I would be mostly focused on securing your own income, because this is going to take years. However much cash you have on hand at the time, and you might think you're going to be able to pick some sort of bottom. All those things are not necessarily going to happen. You might pick the wrong bottom here, and it might take even longer for this to go up. And you might be unemployed because you're currently unemployed and you haven't been job searching, and everyone's going to job search at once all the money runs out. So you need to secure your income for the next few years, and really, you don't need to hit this bottom. What you need to do is be able to hit all these years. So you need to position yourself for all these years so that you can be fully invested before this happens. Right around here, then things started getting a little out of hand, a little bit too much money in the market, and still these are still decent times to invest in, but the market's still go below these. You want to get as much capital in as possible during these years, so you need to secure good income, stable job, invest in yourself, learn something, grab a book, but things faster than that. You need a job. I need a job, so that we can secure our investment during these years and not be left behind when times are good again. That's when we gotta already be done during this. Alright, that's almost done for the day. Just gonna mention a little side note about TikTok. I do have a TikTok myself. Just have a link in the description. But yeah, TikTok might be going away. Sunday, midnight, you won't be able to download it again. Download it now if you haven't before it goes down. And then November 13th, some of the infrastructure around TikTok is going to be coming under pressure. So, I don't know. Is my channel not going to be visible? I will be updating you on that when it happens. The day I'm not able to post a video on my TikTok, I'll let you know. But right now we're looking at the Sunday midnight downloads will stop. And do I think TikTok is going anywhere? Long term, no. But much like many other things, politically and everything else, you have to see some pain before the politicians will get off their lazy ass and do anything about it. They got to have people at their throats complaining. They got to be scared of losing their job. They're not actually here to try to help us. They're scared of losing their job. They would then want to keep their money flowing, or they have their own motivations. But long story short, I believe that any sort of TikTok deal is not going to happen until everyone starts getting angry about it. And that's not going to happen until sometime after November 13th, when everybody who has TikTok, who is posting videos all the time, if their posting is disrupted, if people's viewing, people who are who are on TikTok for hours on a day, anyone who's a millennial or younger, when they can no longer log into their TikTok and watch their videos, then yeah, there will be an uproar. But right now, you just have an executive order that, I don't know if people really believe. They've heard it on the news, but then they log into TikTok themselves and watch some videos, and they see a cat on a fan and they laugh. So there's a disconnect from reality there. They're enjoying their TikTok as if it's always going to be there, and ignoring the news because it doesn't match up with reality yet. So there isn't pain yet. When there is pain, then we will see change. I do believe a deal will come forward on TikTok, but not until a bunch of users get really, really angry. When somebody is afraid of not being reelected because of the TikTok thing, a lot of their voters start complaining at them, then we'll start to see a deal come through Microsoft or whoever, maybe with some Oracle thing. I don't know. It doesn't even matter what they do. But they will, I think, do something, but not until paying first. So wait on that. I'll check back. I'll let you know about my own TikTok channel, how that all happens when I'm no longer able to upload or when I'm not able to view videos. But that's all for today. So like and subscribe. Check out if you want to check out the positions I have, the portfolio. Know that my portfolio is always in flux, so these percentages don't mean necessarily anything. You probably want to look at what I'm currently holding, but even that's not investment advice. You should be doing your own research, and I would not be in any of these companies if I wasn't personally comfortable with my own knowledge of these companies. So if you don't understand the forces behind these companies, it doesn't matter that I'm invested in them. You should not be invested in them unless you understand the future of these companies. Unless you would know what to do with the stock value went down, unless you have looked at the financials and know how they did during the worst few months of the coronavirus times. If you have your own personal thesis for what you think is going to happen in the future because the market is changing. Airlines, for example, maybe you think they're not coming back. I think that their drop may be momentarily. And then over a 30-year trend line, I think the 30-year trend line is barely going to be disrupted. But that it is definitely going to be disrupted over this year, maybe next year. I don't know how many years are going to be disrupted. But I believe it will be a blip rather than a permanent disruption. Your belief might be different. You should not invest in this company unless you have your own belief in whatever that outcome is and your own understanding so that you will be able to act accordingly as conditions change. My current portfolio as it stands, it's not long term. If you backtrack this to the beginning of time, it does not produce a productive portfolio, but I have produced a lot of gains because I am constantly in and out of stocks. I am constantly in and out of one thing and into another. I'm constantly rotating things. Yes, be an expert in whatever you buy. You learn the most about investing when you own a position. So get owning some positions, get learning, get reading those financials. You don't have to really read them. Some people do, but really just the basic looks at just hit the financial button, and just look at what it did in those quarters, in those worst of quarters. It takes a few seconds and just see if they are producing any cash on hand, and having your own understanding of the industry and where the industry is going. So good luck, and let's hopefully make some money off this drop. I made a lot of money off the last drop, so I am very much looking forward to making some money off the next drop. Yes, I'm looking forward to the market dropping. Oh, that's going to cause so much pain. Aren't so many people going to be hurt? Blah, 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 blah. You got to disconnect from that. Yes, it's horrible. A lot of people are going to have a bad time. But it's inevitable. The crash is coming. Therefore, what are you doing whining about it? What are you doing feeling pity for those people that are going to be crushed? I'm not saying you shouldn't try to do good in the world and try to save them, sure, but like, your investment strategy has to be disconnected from that, and you've got to anticipate the bad times and ensure that you are going to make money. Are you going to make money if the market goes up? Yes, I have enough invested in some great companies like Boeing. If the market goes up, I will make money. These companies will ensure that I will make money if the market goes up. If the market goes sideways for a prolonged period of time, and in fact, if the market goes up, even though I will lose money from the short, that would suck, but I have enough stock between my Robinhood and between my M1 Finance. You see, I have about 3,500 in different stocks, or a little less. Equity, your equity. There we go. So, point being is I have enough stocks that if the market goes up, yes, I will make money. If the market stays flat, I will also make money because I have a lot of good, healthy dividends. And if the market goes down, I will also make money because of my shorts, and I will be able to buy into that low because I have a lot of cash on hand. So you want to be fully prepared for all outcomes. Only invested in stocks that you understand, that you're confident in. Not necessarily the stocks I own. There's a lot of other companies I would in theory have or might go into. I'm thinking of getting some AT&T. I just don't have it at the moment, but that's another one I would be in. But only stocks that you are comfortable being in personally, that you understand where they're going. And good luck to us all. Thanks for following. Check out my TikTok in the description, and check back for another update as the market conditions change. As the deflation comes, we will be discussing that further.